Hello, welcome to IGTV. I'm Angeline Ong, and this is a look at your week ahead. Plenty of stuff to look at in the week starting the 13th of February. First up, Australia has got confidence numbers, that's consumer confidence and business confidence numbers as well. And from Japan, we get Q4 numbers in terms of growth. In the UK, we've got the unemployment rate, and from the Eurozone, Q4 GDP as well. This is, of course, the second estimate. And CPI, this could be a huge market-moving event out of the US. And then we move on to Wednesday, the 15th of February, when we'll get the CPI from the UK, hot on the heels of the US, and industrial production numbers and trade numbers from the Eurozone. Stateside, we get retail sales numbers, industrial production, and the latest housing market index, as well as crude oil inventories. Moving on to Thursday, we get trade balance figures from Japan and also Australia, and producer price numbers, housing starts, and initial jobless claims from the US. Going to be very interesting after that very strong non-farm payrolls number. And on Friday, we end with retail sales numbers from the UK and also import and export prices from the US and the Baker Hughes oil rig count. Let's turn now to IG's Joshua Mahoney. Plenty of growth and inflation risk events out there. What is going to spur your biggest trade?
Yeah, look, inflation's going to be really key. We're coming into the week where we've seen the VIX pop higher, and that really signals the potential for us to see equity markets roll over. A lot of that has its footing in the idea that, well, given the fact that we saw such a strong non-farm payrolls figure, maybe the likes of the Federal Reserve and the ECB and the like are serious when they're talking about continuing to raise rates in a bid to drive down inflation. As long as inflation is moving lower, then we don't necessarily need to fear too much. If we start to see inflation tick higher or flatline, then potentially we could see some worries coming into play. Recently, we saw German inflation moving a little bit higher. We've seen French and Spanish inflation moving sideways and upwards. So Eurozone, we're seeing some questions around about that region. This week, it's going to be down to the US and the UK, and there's different stories between the two of them. In terms of the US, I wanted to touch on the dollar index. And now bear in mind that the dollar index by and large is reflecting risk sentiment throughout markets. So if we were to see inflation perhaps move sideways or move towards the upside, you're likely to see strength in terms of the dollar index as people become fearful once again. That's not necessarily what's predicted. Markets are predicting a continuation of the downside move of inflation. That points towards a possibility that this near-term pop is a short-term phenomenon before we roll over, if we see that risk on sentiment coming back into play as inflation continues to move towards the downside. But the UK, I think, is going to be a really interesting one because we've got the jobs report coming out in the early part of the week. We're expecting to see a potential move upwards in terms of unemployment, also a notable move higher in terms of the claimant count. So potential deterioration in terms of the UK jobs picture. And then later in the week, we see downside in terms of inflation expected, but it's marginal and we're still in double-digit numbers for CPI here in the UK. So there's significant risks here in terms of the UK markets, and that's why I wanted to just bring up the FTSE 250 chart here. You can see here on the daily time frame that the uptrend does still remain intact, but we're seeing a sharp move lower to end the week. Certainly, if we break the 159.79, I think this market looks primed to potentially roll over, probably more than others, given the fact that we are seeing the UK economic outlook looking particularly weak at the moment.
Now, Josh, it's really interesting that you touched on inflation and how that is kind of changing the central bank mood as we speak. In the coming weeks, and I'll get back to why I wanted to touch on that, we've got quite a consumer and banks theme in terms of corporate news. Let's take a look at the chart here for you. So all you traders out there, look out for earnings from ThyssenKrupp, TUI, Coca-Cola and Airbnb as well, all out with Q4 numbers. And then on Wednesday, we've got numbers from Barclays, Dunelm, AIG, Kraft Heinz and also Cisco. Towards the latter half of the week, keep an eye out for more bank earnings from Standard Chartered full year there. Airbus is also reporting along with Commerzbank and Applied Materials Q4 results there. And we end the week with more banks, NatWest this time, Allianz and Swiss Re full year earnings from that reinsurer. Now, all this brings us back to a piece I did earlier this week, which I found quite fascinating. The banking industry has been, wanting these higher rates for such a long time, but the problem is their clients, the people they serve, the companies are now being squeezed by inflation and this cost of living crisis.
Yes, certainly. I mean, ultimately, as an investor on the bank side of things, what you want is a strong economy. That strong economy then leads to higher interest rates, and therefore the banks then get better margins and the loans that they provide are relatively secure. Well, we've got one part of that, and that is higher interest rates. So margins should improve. That should provide better bottom line. But we're seeing the opposite in terms of the economic outlook. So the idea that we're raising interest rates into economic weakness isn't necessarily something you ordinarily see, but because it's driven by inflation, that's how we have it at the moment. So really, you've got the two sides of the coin here. Is the economy going to deteriorate so much that they perhaps see a number of defaults on their loan side of the business, and we ultimately see sort of bad debt created for these banks? Or is the economy going to see this soft landing? We don't necessarily see too much economic destruction, and we see nice growth in terms of the margins. That's really what we need to try and ascertain from these earnings as we go forward. NatWest and Barclays, the two stocks to be looking out for. I'm going to be looking out here at Barclays. We can see this recent ramp up in terms of the share price, taking us absolutely perfectly into the 193 level, which is a 76.4 Fibonacci. Now, we're starting to see some weakness as we lead into this week ahead. And certainly, of course, this appears to be people seemingly looking to take some profit off the table as we head into a key risk event for this stock. The 4-hour chart, I think, is going to be really interesting here, because what we can see on a sort of intraday basis is this ascending trend line really propping up support time and time again as we move higher. That's now broken. So look out towards the downside for this first area of swing low support, 186. If we break that level, it does look likely that we are going to see this market move towards the downside once again. But ultimately, it really comes down to what this breakdown is. And if you look in terms of the financials over in the US, we have actually seen it underperform compared to some of the other sectors when it comes to performing against market expectations. Now, that doesn't necessarily mean that it's doing particularly poorly. Perhaps it's more a case of markets having higher expectations when it comes to the financial sector compared to some of the others. But certainly, let's see how Barclays does fare when it comes to really shaping up against market expectations that, if we look over in the US, have been relatively strong and quite difficult to actually achieve.
Thank you very much, Josh Mahoney there. Joining us for the week ahead. Plenty to discuss and plenty of entry points for traders, key events and key trends for next week, growth, inflation, and also on the earnings front, trend and theme in the consumer and banking space.